Welcome to Investing for Idiots. Yes, you've come to the right place. This is a video for the Libra bag holder, option day trader, the Wall Street bets aficionado. I'm making this video for the people, for the victims who find the scams they're in, featured on my videos. And today, we're doing something a bit different. This is a series where we have real experts on the show, and a perennial topic of this series is investing, given that so much of my work is investing gone wrong. We've had Patrick Boyle, the Plain Bagel, and today we're joined by Ben Felix. The whole point of this series is to point people toward channels which give a sound theoretical understanding to finance and moving them away from gambling and financial nihilism and towards basic common sense investing. Welcome to the show, Ben. I appreciate you coming on. If you don't mind, I want to start at the end in mind for those who just watch, the first minute. What is the optimal strategy for most people, not considering individual circumstance, for most people to allocate their money? And then we'll back up to why that is the case. I think you've said that investing is a solved issue. What do you mean by that?
Yeah, I call it a solved problem because we have these tools called index funds, which is what you're, I think, referring to in the question, which are funds that give you really low cost, tax efficient exposure to an entire stock market. So the S&P 500 is an index that a lot of people have heard of. I'm not saying that's the index people should be investing in. We can talk more about that later. But an index is a representation of a stock market. So the S&P 500, the way that they describe it, that S&P describes it, is that it represents 500 leading companies in the US stock market. And it's a capitalization weighted index, which means that larger companies measured by their size, by their market capitalization, have more weight in the index and smaller companies have less weight. So we have these things called indexes. We have these things called index funds that all they do when you invest your money in the index fund is they invest your money in the stocks in the index. And that's a really efficient way to get exposure to the stock market. And so I mentioned not just the S&P 500, there are indexes representing stock markets all over the world. And so you can use these tools to build a portfolio that's going to give you exposure to global stock markets, which is kind of all most people need in terms of building a really high quality portfolio.
Yeah, so there's this. So now I want to thank you for that. I think that is the answer that basically I was looking for, and I've heard so many people say, so many experts say. But now I want to back up to sort of the beginning. Let's just start with a bit about you, and then I want to talk about why it is kind of counterintuitive that experts would tell you sort of not to go with experts. There are active financial advisors, things like that. And we'll get into why you and I think I also think that is not the most prudent strategy for, most people not to get into individual situations. But start with a bit about yourself. What is your background? I think you're engineering to start, right? Just like me. I did chemical engineering. I did nothing with it. And I think you are the same, mechanical, right?
Yeah, that's right. Mechanical engineering at Northeastern. I'm Canadian. I live in Canada, but I went to Northeastern University in Boston. Did mechanical engineering there, and then I came back to Canada and did an MBA in finance after that, and that's how I got into finance. And like you, I never used my engineering degree. Went straight to the MBA.
Yeah. What made you interested in finance? Why were you kind of taken by the idea of investing? And
I wasn't at all. I was not taken by the idea of engineering. I knew I probably didn't want to work as a mechanical engineer, but I was playing basketball. That's why I was at Northeastern. I'm 6'10". People don't often realize that because they see me sitting down on my YouTube channel. So
that's really? Are you joking?
No, I'm dead serious.
Actually 6'10"?
I'm listed at 6'11" for if you go on the Northeastern website, you can see it from when I played.
Oh man.
Yeah.
Wow.
So I played basketball. That's why I was at Northeastern. And then I came back to Canada primarily for basketball. I came to play at Carleton University, which is I don't know what to compare it to. The best basketball school in Canada by far. So I came back to play there, and I had to choose a program, an academic program. So I went there for basketball, but it's okay, I probably don't want to do a master's in engineering. Maybe I'll do an MBA because, that's pretty flexible with what I can do with it afterwards. And then I picked finance for the same concentration in finance for the same reason that I picked an engineering degree in the first place, was that it was kind of the hardest program. I was told mechanical engineering is the hardest thing you can do. And I was all right, I kind of like mechanical stuff. I'll do that. And then same thing for finance. Of all the streams you can pick in the MBA, finance is the hardest one. So all right, let's do it. And that's it. But I was never I love investing or I love finance. No, I do now.
Yeah, no, I was going to say that really bleeds through a lot of your videos, that actually you are very interested in the research side of finance. That's how I found your videos. Is I was looking for somebody who talked about not just like their opinion about stocks, but what the research actually said. And you'll often cite, journals and articles in your videos, which I really appreciate. But it's interesting. So the counterintuitive thing that I want to get at in this video, why I'm calling it Investing for Idiots, besides the provocative title, is that I think it is interesting and deeply counterintuitive that in most industries, expertise is how you get the superior advantage in the field. So if you would want, something done right, you hire an expert to do it for you. That is the intuition that is at the heart of almost everything we do in the world. And there's like a saying, you get what you pay for, right? There's a reverse saying in finance now, which is popularized by, I think, Jack Bogle, which the founder of Vanguard, where he says, in finance, you get what you don't pay for, meaning that it's the reverse, and that oftentimes hiring the best wealth manager in the world will lead to worse outcomes than doing the very, at this point, now simple and dumb thing, and the idiotic, it almost feels too dumb, which is hold a very broad, diversified index fund, not choose stocks, not choose timing, not choose any of the things that you would think you would have to do if you want to achieve a kind of above average is a bit misleading, because actually you're getting the average, but getting the average is, in finance, weirdly, above average. Can you break down why this is the case? That is deeply counterintuitive.
So I think the average return piece there that you just mentioned is actually really important. That with index funds, I've heard people say like, well, why would I just settle for the average return? Why wouldn't I try and do better by picking stocks or timing the market? But I think if you look at what are average returns, like what are the average returns of investors, or what are the average returns of actively managed mutual funds, they're way below index fund returns. So I think what you said is not incorrect, that you're getting, relative to other investors, you're getting above average returns using index funds. You're getting the market return, which is the average. But if you compare yourself to other investors or other types of funds, I think you're getting an above average return with index funds. Why is that the case? Expertise is weird in financial markets. I think it's because financial markets are competitive. They're a competition. Now, if you have one skilled person and nobody else is doing anything to price stocks, stocks are priced based on trading. So if I think a stock is worth more and you think it's worth less, we might have a transaction. And every time that happens, it puts information into stock prices. Now, everybody wants to make a profit. If there's one person pricing assets and nobody else is there, they could make a lot of money, because there'd be a bunch of mispriced assets and they could go decide what to pay for them, and they'd become very wealthy very quickly. But that's obviously not the reality. There's a bunch of people competing to be the one putting their information into the price to try and make a profit. And that competition is what sets stock prices. But it also results in a situation where if you've got two extremely skilled traders, we talk about active manager underperformance. And I think a lot of the times it almost becomes pejorative, where active managers are dumb. And I don't think that's the case. I think they're some of the smartest people in the world. Like finance has become this brain drain for all the other smart fields. So it's really smart people, but they're competing with each other to be the ones to make a profit. And when you get that, you get this thing called the paradox of skill, where when the players playing against each other in a game are increasingly skilled, the outcome is increasingly determined by luck rather than skill. Take like NBA games, for example. You take two NBA players that are equally skilled and make them play one-on-one against each other, and they play 100 games, like the winner's gonna be determined by luck, assuming they're equally matched. Right. So I think that's it. There's a paradox of skill, and it creates a situation where being skilled does not lead to better outcomes. And then for investors, the you get what you don't pay for comment is because for the service of hiring someone to try and do that for you, you're going to pay a high fee. You're also going to have high transaction costs, because every time they trade, there's a cost, implicit or explicit, or usually both. And so net of fees and costs, trying to beat the market on average is going to be a losing game. So you got those two pieces. One, the outcomes are determined by luck because all the players are so highly skilled. And two, you're paying a cost to participate in that game to try and beat the market. And so net of costs, on average, you're going to lose. It's a losing game.
When you say it sounds simple, but it is hard to get your head around. And I have a bunch of family members, for example, who will tell me like, yeah, I've got this active manager. He's charging me, sort of 1%. And I want to I want to shake them. I want to just tell them like, this is going to be horrible for you. But they just always tell me like, no, this guy's a smart guy. He's a smart guy. And I've said something in the past, and my wife has told me like, hey, you got to stop this. You got to stop. You don't need to evangelize about this, because for some people, they need this guy. They wouldn't save the money if not for the fact that somebody's holding, like if they were in charge of these decisions, they wouldn't act as rationally as you think they would act, which is they would just put it in, an index fund and just hold it. There also is this piece, which I think is hard to understand and wrap your head around when you think about it in terms of like textbook math versus there's a behavioral side of this too. How do you think about behaviors as they impact returns, and how do people work against themselves, so to speak? I think there's like a saying, like we've met the enemy and the enemy is us. That I think is true of most people who are investing.
Yeah, for sure. I mean, when you look at the data on how do investors perform relative to the assets that they invest in, so you can look at that for indexes, you can look at it for mutual funds. Investors pretty much always underperform. So you take a stock index fund, for example, or a stock index, and the index returns, 8% a year or something like that. Investors typically earn less, 7% or 6% or something like that, depending on what asset class we're talking about.
Explained by what?
That's the difference. Well, what's the explanation for the behavior?
No. What is causing that underperformance? Are they just trading it because they trade at the bottom and they buy at the top?
It's bad timing decisions. Yeah. So it's really comparing money weighted and time weighted returns. I mean, finance terms, I guess, but there's this gap. If people are investing at the top and selling at the bottom, there's going to be a difference between the money weighted and the time weighted return. The mechanics of that don't really matter, but that's why we see those gaps. It's poor timing decisions, and that's really it's really everywhere, and it's been around for a long time. But I think your comment about the person needing handholding is important, because there's a separation between the investment strategy and the fact that somebody may need investment advice. Now, I'm biased here because I'm the chief investment officer of a wealth management firm. We use low-cost funds to build portfolios. Like, we believe all the stuff that I'm saying on the investment management side, but I still do think that there's room for hand-holding, as you called it, but also other things like financial planning and tax advice that people need. So I don't think those two things have to be combined. Someone who's giving financial advice doesn't have to be selling you crappy high-fee investment funds.
Unfortunately, that has been the synonym for a while, where financial advice has become synonymous with like this self-dealing that is happening, where they're selling often tools that they are getting kickbacks from selling. So that is just an unfortunate, I think well-deserved reputation of the financial.
It is well-deserved, yeah. I agree.
Industry. But you touched on something which I think is worth talking about, which is market efficiency, where you said, as the players get better, then the outcome is increasingly determined by luck, which brings me to a question, which are markets getting more efficient as information gets faster and the players become more sophisticated?
Market efficiency is a really, really hard question to answer. Whenever I ask academics about this on my podcast, they kind of laugh and like, how are you defining market efficiency? How do you want me to define market efficiency? Market efficiency is technically, as kind of the plain English definition, it means that prices reflect all available information. Stock prices reflect all available information. Now, how do you actually test for that to check like our market's getting more efficient? There are a lot of different ways. None of them are completely conclusive. But if you look at something like information production, so is information about individual stocks being produced at a higher rate or a lower rate than the past? I think from measures like that, markets are at least as efficient as they've been in the past, possibly getting more efficient. But that's not the only thing that matters. Like, another big one is active manager performance. So we talked about, can active managers beat the market? And that's been pretty stable for a very long time. Very few active managers are able to beat the market. If markets were getting less efficient, we might expect to see that reverse. The other thing, so yes, information is more available. Yes, technology is getting better. The other thing that we're seeing, though, as a big trend is that a lot of people are moving to index funds, which means there are fewer dollars invested with active managers. And the way that prices got right in the first place is because the active managers were trading on information trying to make a profit. So this is a thing called the Grossman-Stiglitz paradox. It's basically, the paradox is basically that markets can never be perfectly efficient, because if they were, there would be no more information production. It's kind of like an equilibrium, though, in reality, where if the pendulum ever swings too far toward passive, there will be opportunities for active managers, and then at least in theory, they'll come back, make a profit for a bit, and then markets will be efficient again.
Yeah, because fundamentally, index fund investors are sort of getting a free lunch of the work of active managers to determine the price of stock, the fair price of stocks. Talk to me about diversification and what a type of risk is that you can diversify away and things that you can't diversify away. Because I think this is also something that's counterintuitive, where you go, why would I buy a basket of stocks when that basket of stocks is for sure going to have a bunch of losers, like stocks that are going to be terrible? Why would I not just pick the stocks that I know are going to be good? You know, I know, hey, I believe in Tesla, or I believe Palantir, Alex Cart, whatever his name is, that guy, you know, he's got big ideas. Ben, why don't I just invest in that instead of your dumb idea where I, invest in these losers? What is the answer to that?
Yeah, it's really easy to identify past winners. Like, we can say, hey, that guy's really smart, or hey, this company's doing really, really well. That's reflected in the price. And so I think that's a bit of a trap that people can get caught in, where people can end up paying a really high price to invest in an objectively good company. But because you paid a high price for it, your investment returns are going to suck. We've seen that happen throughout the course of financial market history again and again. Like, again, back to investor behavior. It's something that people kind of love to do. They love to overpay for exciting companies. More generally, though, the problem is most stocks perform poorly. They perform poorly relative to treasury bills. They perform poorly relative to the market. A few stocks perform really, really well. So, I mean, to your question, can we identify those winners ahead of time? That's really, really hard to do. And because most stocks perform poorly, you're much more likely to pick losers than to pick winners. So if you look at people building concentrated portfolios, there's a study that looks at this. If you build concentrated portfolios of stocks, you're much more likely to underperform the market than to outperform it. So that's concentration. The risks that you can diversify away are company-specific risks or industry-specific risks. So that's like, take two companies that are otherwise identical. They're exposed to the same big picture risks, but one company's CEO starts doing some crazy stuff that the market really doesn't like. That company is going to do relatively poorly. Its returns are going to be relatively poor compared to the other company because of what the CEO is doing, not because of anything that's going on in the overall market. So that's company-specific risk. That can be diversified away by owning all of the companies in that industry or sector.
Okay. Right.
And then when you diversify all the risks away, like company-specific risk, you've got industry risk, which you can diversify away by investing in other industries. You've got country-specific risk, which to an extent you can diversify away by investing in other countries. And then you roll all that up, you're left with what's called market risk. The reason this matters is that market risk is priced. That means you expect compensation for taking on market risk. You do not expect compensation for taking on individual company risk or industry risk.
Is this why they say like diversification is the free lunch in finance, or like there's some saying about that? Because you're actually getting above average, or you're getting extra expected return for not taking on more risk, where most of the time getting more return means taking on more risk.
Yeah. So if you diversify with a bunch of risky assets, so stocks are risky. If you have a whole bunch of them, you're reducing your risk without decreasing your expected return. Whereas typically in finance, if you want to take less risk, you have to expect lower returns.
So why do all these people pick stocks?
I think it's exciting. I think people think they're smart. I think there's a lot of overconfidence in investing. Whenever I make a video,
I'm smart.
Yeah, everybody does.
No, that's why this video is investing for idiots. That is like the whole premise, is that kind of the most genius thing to do as an investor is to know what you don't know and kind of take the counterintuitive position of realizing that average returns are really easy to get and above average returns, slightly above average returns, are incredibly hard to get, and almost no one gets them. That is the very odd thing at play here.
Yeah, and you're introducing a whole bunch of risk that you're going to get below average returns by trying to get above average returns, and you're much more likely to get below average returns. I think it's the overconfidence. People want to believe that there's a smart person out there, or that they're the smart person that can give them a outperformance. But yeah, it's not very well supported.
Okay, so I got another question for you, which is, I hear about AI, hot topic, robots, hot topic. I want to screw the total market index. I want to put my money in the roll the dice in the AI funds, in the whatever. Why is that a bad idea, or a good idea? Is it a good idea?
So I got a lot of questions about this when ARK, Cathie Wood's fund or funds were doing really, really well. Like there were a couple of years or a few years where they were just crazy rocket ships, crushing. And so I started getting questions like, why would we invest? Because her narrative was the index has all these old, boring companies that really suck and they're not innovative, and we're going to pick the innovative ones that are going to do really well. So I started getting questions from clients like, why wouldn't we? Why would we want to invest in these old companies? Why wouldn't we want to invest in the new economy? So I did a lot of work digging into that. I made a couple of videos on it, on investing in technological revolutions. I did one on superstar fund managers or something like that too, which those two things often go hand in hand. So what tends to happen? Why is investing in revolutionary technologies or new economy stocks historically a losing game? It comes back to asset pricing. So when something's really exciting, so AI, for example, I think crypto went through this too. Marijuana stocks went through it too. Electric vehicles, I mean, it's just recent history, but this is something that happens throughout history. Railway stocks went through this too. So what happens is people realize this thing is exciting. They realize it's going to be impactful, and asset prices start to reflect that. And so the asset prices shoot up. And what happens when asset prices shoot up? More people hear about this thing. Oh, AI, it's going to be really big. And the stock prices just went up a bunch. So more people invest in it. And the price keeps going up. And that cycle carries on for a while. And you see asset prices go up, up, up. Investors tend to buy after they've gone up. And then they tend to come back down. Because nothing tends to be as as revolutionary as quickly as I think people expect.
And you have a dilutive factor, don't you? Like the companies also are issuing a bunch of new shares. You're not capturing the full profits of that sector that you think you are.
Yeah, that's one of my favorite pieces of this whole thing. So you get high asset prices. And one of the reasons that they're high, I've heard someone call this the big market delusion, which is basically that every stock is priced as if they're going to capture all of the market share of that new industry. But that's never what happens. So even if there is a massive amount of new earnings that are going to be available for an industry to capture, when it's a new exciting industry, like you said, a lot of companies are going to issue new stock. A lot of new companies are going to be created. And so there's this huge earnings pie, but it's not one company capturing it. And the more companies that go after that huge earnings pie, the lower the earnings per share, which is what matters to investors, which is what matters for stock prices, is going to be. And so you can end up with massive earnings growth for a new industry and really bad earnings per share growth for all of the companies that are issuing stock to try and capture that new opportunity. And so investors end up just kind of getting hosed. And this is like, you go back through history, this happens again and again and again. High stock prices, exciting technology, investors buy at the peak and they get smoked.
This is what is so interesting to me about finances. There are all these traps for otherwise smart people to make catastrophic mistakes with their finances because of things that seem intuitive until you know a bit more of the picture. I have a guy, I won't say his name, but a very, popular finance guy on YouTube, and he's telling me behind the scenes, oh, you got to invest in, this smart, industry and da-da-da-da-da. And he was making the case so strongly to me that I was like, what is the research on emerging market? Like some of these really, interesting industries. And that's when I found your video and I was like, oh, this is not the easy buy that I thought it was, where it's just buy a few of these, hot AI stocks or hot robot. It's going to be the future. It's not as simple as I identified, as if everyone can't see that AI and robots are going to be an important part of the future anyway, to say nothing of that. I want to touch on an interesting piece, which is that even though we all know past performance is no indicator of future, results, we all kind of behave a little bit differently than that. Everyone sort of behaves as if the opposite is true. And I want to talk about U.S. versus international, right? This is a big conversation where the U.S. has sort of, especially in the past decade or so, has sort of crushed. And so there is a narrative that crops up every time something like this happens, which is, well, I just want to abandon this loser, which is everybody else but the U.S. U.S. number one. We're the kings. Sorry, Canada. You guys are. Sorry, you're not performing. I'm dumping the loser from my portfolio. In theory, intuitively, like if you just didn't know anything else, there's some tendency to believe that idea. Can you explain why this might be a problem and explain the trend of U.S. assets to have become higher priced PE-wise relative to other international assets? AKA, is investing in international stocks a dumb idea?
Yeah. So the U.S. market has been wild for the last 15 years. It's been just, insane. Incredible. Insane. Yeah. Like anyone that was not investing in the U.S. over that period, like you missed out on a lot of returns, and you don't get those back. Like that's it. Which is one of the reasons that, even though we're about to talk about U.S. expected returns maybe being a little lower than the past, I don't think that means anybody should get out of the U.S. market, because I could have said the same thing 5 years ago, and here we are. The U.S. market has been incredible. So what has happened over the last 15 years, but really over the last 30 or so years, is that U.S. stock prices have gotten higher relative to their fundamentals. The fundamentals have been good. There's no question there. The U.S. market is objectively strong economically. But the other thing that's happened is the valuations of U.S. stocks have gotten higher and higher and higher. And right now, if you look at the Shiller price earnings ratio, which is one way to measure stock market valuations, it's not as high as it was in the year 2000, but
it's really high, Ben. It's really high.
It's about as close as it's been since the year 2000. And, it's not conclusive by any means, but typically when stock prices are high, expected future returns are low and realized future returns are low. Like if you go and sort historical U.S. market returns by their starting CAPE, their starting cyclically adjusted price earnings ratio, higher starting CAPEs are associated.
Explain what
with
you just
lower.
said. What's a CAPE? I'm sorry.
Sorry. Cyclically adjusted price earnings ratio. So it's a way of measuring stock market valuations. It's the 10-year smoothed real earnings of companies. Yeah. So you're measuring the prices relative to that smoothed earnings figure, and that just helps to balance out big changes in earnings from year to year. And so that measure is really high right now, meaning buying $1 of earnings of U.S. company earnings is really expensive right now compared to history. And historically, that had been associated with lower future returns. Now, what does this mean does international investing make sense? If you look back to 1980 or so, up until now, a huge portion, the U.S. has completely obliterated international stocks over that period. And a huge portion of that difference has come from rising valuations. And so if we think about, is the same thing going to happen for the next 20 years, for the next 30 years? It's really hard to say that U.S. valuations are going to keep going up the way that they have over the last 15 or so years to deliver the type of returns that people might expect when they say, oh, I'm only going to invest in U.S. stocks. So I think that's a little bit of a trap. Currently expected returns are low. They're low partially because past returns have been high, which has led to increasing valuations. And so people see the past returns and they project that into the future. But in reality, they should probably, if anything, be expecting the opposite, lower returns. Now, if we look at U.S. versus international stocks throughout history, I looked at this a while ago. I looked at 10-year rolling periods from, I think, 1900 to 2023 or something like that. And it was about 60% of the time that U.S. beat international, which is like, it won most of the time, but it wasn't all the time by any means.
It wasn't what you'd expect if you were only alive from 2010 or something.
That's right. So yeah, I think international diversification makes sense. I made a video on it. I diversify internationally. The U.S. is only one part of the world. It currently makes up about 65% of the global stock market, which is a lot. It's increased each year, partially because valuations have been going up and up. But there's a huge portion of the global stock market that is not the U.S. And the U.S., I don't think, will perform the way it has in recent history forever. And historically, when the U.S. has faltered, when it's had lower returns, international returns have been better, relatively speaking. And that's diversification. It's like basic.
This is another way to diversify. It's just interesting because people who talk about diversification, especially in the U.S., are usually talking about U.S. equity diversification. They're not actually, they don't want to diversify to the rest of the world. They're like, they actually want to bet on their country. There's a bit of a country preference of, and we have historical returns. We look back and we go, see, look, we proved it. We're the best. We want to, but it is interesting. Like the same, I find this interesting because I follow some of these, there's this community called the Bogleheads. Have you heard of these guys?
Oh, I've heard of them. Yep.
These Bogleheads, they're like people who more or less subscribe to the theories of Jack Bogle, the Vanguard kind of father of index investing. And to some, I don't want to treat them all as a monolith, but some of them have issues with this idea of international. Like most of them are like, look, even people who in theory completely subscribe to the idea of diversification sort of have subscribed to it because they go, look, I don't want to really hold that much. I back tested this and I'm a little smart. And I found out that, international is not worth holding. So I'm fully US. And then Jack Bogle even himself is like, I don't hold any international. I hold and max 20%, something like that. So if we are looking at this from what I wanted to give my audience is no advice, just a theoretical understanding, a framework for how to think about this. In my mind, this is an irrational side of both Jack Bogle's philosophy and in the philosophy of a lot of people who even subscribe to diversification. If you really subscribe to it, you kind of have to subscribe full send unless you're making arguments about like tax efficiency of international, I guess. But what is your thought about that? Do you think that the most sound theoretical framework is just buy everything? And if that's true, do you buy more than just equities? Do you buy commodities?
Yeah, where
do you
does
buy
it stop?
oil? Yeah. What is your answer?
Yeah. So I think on the international diversification piece, if someone wanted to be only U.S. equity, it's probably not the end of the world. I don't think it's a good decision, but there are worse countries to invest 100% of your wealth in. Like the U.S. is 65% of the global market. And it has companies that do have exposure to markets all around the world.
Right.
It's not quite globally diversified because U.S. companies that sell overseas are going to perform differently than companies overseas. So it's not perfect. But again, if you wanted to invest in one country, the U.S. is probably the way to do it. I do also think for U.S. investors, like you mentioned tax, there's also currency issues, costs. There are reasons to have home country bias if you're in the U.S. or elsewhere. Like in Canada, many people have a home country bias, and I think to an extent that can make sense just because of the frictions of owning foreign stocks. There's other weird stuff too that you can start thinking about, like the risk of expropriation by foreign governments in times of conflict. Like those are real things that are worth considering and thinking about diversification. Mm-hmm. So I don't think it's the end of the world if a U.S.-based investor said, I'm going to invest everything in U.S. stocks. I'm not recommending that or suggesting it, and I've argued against that, including with the Bogleheads community many times. Every time I make a video on international diversification, they lose their minds.
Yeah.
Yeah.
Hey,
So
by the way, I like this guy. I like that. I'm not
too.
hating. I think they're one of the more sound, financial groups out there, actually. But and they have, interesting discussions. But it is something that's cropped up that I think is interesting because I'm like, wow, this knowing the theoretical underpinnings and actually believing in it when you have all this data that kind of pushes you towards, well, the U.S. seems so good, is hard to. It's kind of hard to argue against the past performance of a guy who's like, I invested in the U.S. in the last 40 years, and everyone who invested in international is an idiot compared to me. And like, in theory,
it's true. So
yeah, not in theory, but I guess in practice, he's right. In those 40 years, he was right, correct. Just like if you invested in NVIDIA for the last 10 years, and I'm going to come to you and say, hey, you shouldn't have done that. And they would say, well, in theory, you're right. In practice, you're wrong.
Yeah. I think there's a little bit of rear view mirror bias because the U.S. market has done so well in recent history. But you go back, like from 2000 to 2010, U.S. stocks returned 0 for 10 years. It's like those periods happen, and over that period, other stocks elsewhere did better. I mean, even in the U.S., I don't know if we're going to talk about this, but even in the U.S. market, which is what everybody sees the past performance of right now, was flat. U.S. small cap value stocks over that 2010 period did incredibly well. That's not quite diversification. That's not like an appropriate term for it. But investing in something other than the U.S. market capitalization weighted index can make a lot of sense in some cases. The theory piece of that is pretty simple. If markets are efficient, the global portfolio of assets is the theoretically optimal portfolio. And it's pretty simple. That's the basic argument for why you should be globally diversified.
Okay, question on top of that, because you say that, Ben. You say that, but you don't do that. You don't do that in your own life. You do a little thing called the slice and the factor tilt.
Yeah.
What are the, see, I've done my research. I've done my homework. What are the factors in the FAMA French model? What is the FAMA? Let's back up. Who's FAMA? And does he know French? And what are these things?
I think we have to back up even further, actually. I think we have to go back one step further to...
This is for idiots, Ben.
Yeah, we're going for idiots. Yeah, I'm gonna do my best here. So we talked about market risk earlier. You can diversify everything away, and you end up with market risk, and that's the one priced risk. That's the risk you expect compensation for taking.
Okay.
And you get that by owning an index fund, a total market index fund. So that idea really comes from a 1964 paper in the Journal of Finance by a guy named Bill Sharp, who won the Nobel Memorial Prize in Economic Sciences for this work. He came up with this thing called the capital asset pricing model, the CAPM. And this model basically predicts, I hope this is not too nerdy, but it basically predicts that expected returns are explained by exposure to market risk. So you take on market risk, you get an expected return. If you take on more market risk by owning stocks that have a higher market beta, that's pretty nerdy talk, but riskier stocks should have higher expected returns in his model. But it's a single factor model, meaning market risk is the only risk that explains expected returns. So that's 1964. From then until the 90s, there were a whole bunch of things that were violating that model. So there were a whole bunch of types of stocks where if you looked at their CAPM, if you analyze them through the lens of the CAPM, it looked like they had higher returns that were too high for the amount of market risk that they were exposed to. So that could mean two things. It could mean markets are inefficient and that there are all these profit opportunities, these risk-free profit opportunities for people to take. Or it could mean that the capital asset pricing model was not the best model to explain how assets are priced, to explain what risks are incorporated into stock prices. So this is where Fama and French. Fama is the guy who came up with the idea of market efficiency in the 1960s and 70s. And his co-author, Ken French, they came up with the idea that maybe there are more than the one market risk. Maybe there's more than one risk that investors care about when they price assets. Because the CAPM was empirically wrong, meaning you could find lots of places where it was not working.
Yeah.
So they came up with this a three-factor model where they said, it looks like investors probably care about market risk, but also the specific risk of small stocks and the specific risk of value stocks. And those were two of those empirical irregularities. Is this dumb enough? I don't know. Like, we'd be in.
No, yeah, this is fine. No,
Okay.
You want to explain value versus growth real quick?
Yeah. Okay. So value, the way that Fama and French measure it, they measure price relative to book value. So the book value is like just the value of a company's assets. And then its price is the value of its assets plus the discounted value of future cash flows. So basically, if people think a company is going to do really badly in the future, it might trade at its book value. Like, this company is going to generate no profits. It really sucks.
Right.
If a company is going to do really well, it's going to have a really high price relative to its book value. So a growth stock would be a high price relative to book value stock. A value stock is a cheap stock. It's got a low price relative to its book value. So they had observed that value stocks tended to beat growth stocks over time. Likewise, they'd observed that small companies measured by their market capitalization had tended to outperform big companies. So they added these two independent factors to the asset pricing model. And all of a sudden, a lot of those empirical irregularities that the CAPM was failing to explain, they kind of went away. So from that paper, this whole field of financial economics was born called multi-factor asset pricing, which is really the study of like how are assets priced? Like what information goes into the price of a stock? What do investors care about? So they had that 3-factor model, and they later in 2015 came out with a 5-factor model.
Let's not talk about the 5. Let's stick with the now. For now.
Yeah, that's the 3-factor model is really it explains the CAPM explained like 2/3 of the differences in returns between diversified portfolios. The 3-factor model brought that up to about 90%. That means like if you take two actively managed portfolios, for example, and ask why are their returns different, the CAPM is going to explain about 2/3 of it. The 3-factor model is going to explain about 90% of it. The 5-factor model explains about 95%. So there's definitely some diminishing returns.
That is to say, their returns are explainable as a function of the amount of risk they're taking on.
That is fundamentally the whole idea is exactly that. Yeah.
So, because this is something that was confusing me when I first learned about this, is I was like, oh, are the factors like another way like diversification to get sort of this free lunch? Like I just buy more small cap index funds and I buy more value stocks and I just get better returns as opposed to people who buy the whole market index. Is that what you're saying?
Well, theoretically, they are independent risks that a lot of investors probably should not be taking. And that is why they're compensated. So the market portfolio, in theory, the market capitalization weighted, like you go and buy the market index fund, that's the optimal portfolio for the average investor. Now, if you're not the average investor, if you're in a position to take more risk than the average investor and take more risks that show up at really bad times than the average investor, like risks that will show up at the same time that you might lose your job, somebody who has a job that's exposed to those types of risks, they maybe shouldn't be investing in value stocks. Mm-hmm. Someone who's retired, for example, and doesn't depend on their income at all, maybe they can take a little bit more risk by tilting toward value stocks. But they're not for everybody, and they are risk, at least in the Fama French thinking, they're risk premiums, which means like, no, it's not a free lunch. It's an additional risk that you're taking, and doing it can suck. Like if you were investing in value or small cap value stocks over this recent period where the US market's been going nuts, it hurt. Like I have a value tilt in my portfolio and it sucks.
Yeah, because growth actually has been, value doesn't always beat growth, and growth has been killing.
Yeah.
Anyway, I wanted to kind of bring that up because it's an interesting, deep dive on the specifics of, diversification. People talk about these factor tilts. They're not talking about the same thing as diversification where you get sort of an increase in expected returns for no additional risk. You are getting an increase in expected returns for taking more risk. Just like if you were to have, 100% equities versus having 80-20 bonds or something like that, you would expect more return, but you're taking on more total risk. I think probably we should touch on bonds a little bit. Everyone kind of is bored to death by bonds. But for the first time ever, they've become a little bit interesting. Well, at least the first time in sort of my investing lifetime, where they're actually paying something. How do you think about bonds in somebody's portfolio? So far, we've just been talking about equities, but that is not sort of the commonly understood way to invest, because if you want to diversify, you should also be thinking about diversifying away from just pure market risk as well, depending on how much risk you want to take. What is the kind of theory behind why someone should consider bonds in their portfolio? What are they? Maybe just jump into that.
Sure. So stocks are pieces of equity ownership in a company. You're participating in the expected future earnings of a business. And because of that, they can fluctuate a lot. Businesses can have bad times. And so stock investors are exposed to a lot of risk. So that's investing in a company's stock. There are also these things called bonds, which is another way for companies to raise capital. If they don't want to issue stock, they can issue bonds. And they're effectively borrowing money. So if you buy a bond, you're kind of lending money to a company or to a government or whatever, and they're going to pay you interest. They're called coupon payments. And then at the end of when it matures, they're going to give you your principal back. The other interesting thing is that if a company goes bust, stockholders usually get zero. But bondholders often have some claim on assets. So there's a couple of different reasons there. Like you've got guaranteed payments, you've got principal at maturity, and you've got potential claim on assets in a worst case scenario. So all of that together suggests that bonds are a little bit safer than stocks, which, it's more complicated than that, but that's kind of step one. They're a little bit safer.
Yeah, I want to talk about what is risk later.
Yeah.
If you have time. I don't want to take too much of your time, but okay. The point is a little bit lower downside. In theory, bonds have a lower downside risk of losing money, especially when you talk about what a lot of people are thinking of when they think of bonds, at least for their investment portfolio, is some type of government bonds or high-grade bonds. For a while, the U.S. especially has been in an odd position. I don't know the interest rate situation around the world, but the U.S. was in the interesting position of paying very little for bonds. So there was, what's sometimes known as like the risk-free rate for the least risky thing we can think of is like sort of what the government going bust. So the closest thing to risk-free as you can get was basically nil. I mean, nearly nil. So how should people think of bonds? And there's long-term bonds, there's short-term bonds, there's medium-term bonds. Ironically, these have different types of risk because when I first understood bonds, I was like, oh, well, the long term seemed the safest. Get a 30-year bond, you're guaranteed to have that payment for, like, what's the risk? Can you explain the different types of risk of short, medium, long-term bonds?
Yeah, really interesting question. No, it's a great question. It's not an investing for idiots question,
Idiots?
but I love it. But I love the question.
Okay.
So shorter maturity bonds are going to be really low in volatility. So volatility is like the price can change. If you buy a short or treasury bill, for example, like it's basically like cash. Like you're going to earn some interest. It's not going to move around. The price is not going to move around. As you go longer out in maturity, the price is going to move around more and more day to day based on changes in things like interest rates.
Break that down, because if I buy a 30-year bond today at 5%, just so everyone's clear, I will, if I wait the full 30 years, the price doesn't fluctuate and the interest rates don't fluctuate. So why are you saying that the price fluctuates?
If all of a sudden tomorrow, so you've got a bond that's paying you 5%, if all of a sudden tomorrow I can go and get a bond for 6%, your bond is going to be worth relatively less in the market. So it'll be repriced based on what the new rates are. And if you went to sell it, you're not going to get your principal back. So, and because assets are priced daily, you're going to see a price fluctuation. The longer you go out in maturity, the more extreme those price fluctuations are going to be. So at like the 30-year mark, they can be extremely volatile. But now back to your question, what is risk? So for short maturity bonds, you're not going to have any volatility, which is one way to think about risk. You're also going to have a relatively low interest rate. And if you look in the data around the world for how to bills, like very short-term government debt obligations, how do they perform? There's a pretty good chance you're going to lose money in real terms holding very short-term debt. So they're not volatile, but there's a good chance they won't keep up with inflation. So you're not taking on volatility risk, but you're taking on the risk of losing your purchasing power. If we go to the other end of the spectrum, it's nominal bonds what we're talking about. So bonds that don't adjust for inflation. There are also real bonds or TIPS in the states that do adjust for inflation.
Keep them out. This is an idiot's class.
It's hard to ignore them. So I'll talk though about long-term bonds. Like you mentioned earlier, if you have a nominal liability, and that's important, it's frustratingly complicated, but it's important. If you have a nominal, so it's $100,000, but it's $100,000 nominal. So it's not going to change in real terms. Like there's no inflation on this liability that you have.
Right.
And you buy a bond for that, you're going to get your interest over time and you're going to get your principal back at maturity. And even the price fluctuations in the interim are not going to matter to you because you have this 30-year liability that you need to fund and you don't care about the interim. So it's going to be volatile, but it's going to hedge your future liability. The problem is most liabilities are not nominal. Like I don't think an individual house, like you or I, do not have nominal liabilities. I don't think in anything. Like there's nothing that I'm going to want to buy in the future that's not exposed to inflation. Insurance companies have nominal liabilities because someone buys $1 million insurance policy, it's going to be $1 million insurance policy in 30 years or whatever. But we households, people want to buy stuff, food, whatever. Those are real liabilities. So a nominal bond, even if it perfectly hedges a nominal liability, can be extremely risky in real terms. And so this gets to the really interesting thing. But now you can buy an inflation protected bond to hedge that real liability. But bonds more generally, nominal bonds, how do they fit into portfolios? They reduce your volatility for sure. Adding bonds to your stocks reduces your volatility. But they probably decrease your ability to maintain purchasing power in the long run. And so
we should first we need to probably define what volatility is, even though we've been talking about it for a while, because most of us, myself included, I usually think of risk just in terms of volatility. Like, the risk that price will go up or down and the size of those swings. But that is not all that risk is. Risk is actually very hard to define. Anyway, go ahead. What's volatility?
It's the price, how much the magnitude of price changes, I guess, is one way to think about it. So a stock is going to be volatile. It's going to be worth, $10 today, but it might be worth $15 tomorrow or $5 tomorrow.
Bitcoin is volatile. Bitcoin one day it's worth 10,000, one day it's worth 100,000. And then as compared to that, we talk about bonds as being less risky. What do we mean by that? We mean they are going to be subject to lower price fluctuations. But that, as you say, is not the only risk. A huge risk that we, all are concerned with is, okay, in 30, 50, 80 years, when I need to fund some retirement, do I have enough money as relative to my standard of living and the inflation that has happened during that period of time? That is a huge risk and there is an argument, maybe you could give it, that having equities as part of your portfolio actually de-risks that.
Yeah. So equities are very risky in the sense that they're volatile and they do have an uncertain long-term outcome. Like there's no sane world where I would say that investing in stocks is going to give you a guaranteed inflation-adjusted return in the long run. There's still a chance you lose money. But relative to nominal bonds, stocks have historically been much safer. There's a paper on this that's not published yet. It's going through like the conference cycle and stuff, and it's getting interesting comments. I've been talking to the author about it the whole time, but the paper's called "Challenging the Status Quo," and it's basically saying that the status quo is that people think they should start out investing in stocks when they're younger and then add bonds as they get older because bonds are safer, and that's like common sense.
Textbook.
Right.
Yeah.
And so their paper basically shows that if you go and look at they use global data going back to 1870, and they did something called bootstrap simulations. Basically, they created a whole bunch of hypothetical scenarios using actual historical data. But it gave them way more potential hypothetical scenarios based on historical data than we actually have historical data.
Right.
And what they found in those simulations is that the optimal portfolio for the whole life cycle is 100% stocks. Now, this is it's pretty controversial because their data show that, like, a lot of people get really upset that anybody would possibly say that, but it's at the very least, it's a very interesting finding. And it's driven by the fact that stocks are still very risky. And they emphasize this in the paper. Stocks are still super risky at long horizons, but bonds, nominal bonds, are a lot riskier. You're much more likely to lose money in bonds. And so adding them to your portfolio,
That's crazy.
Right. Adding them to your portfolio makes it riskier. It makes it less volatile, which is great if you're really worried about volatility, but it makes it riskier from the perspective of funding your future consumption.
Okay. That being said, one thing that always freaks me out about things like that, and maybe this is the slightly risk-averse, volatility-wise guy in me, which is that every financial investor can read all the theory till they're kind of blue in the face, but they only get one shot at the financial markets, and they can't predict beforehand what their ride is going to be. So They have all this history, but they're guaranteed a different ride than the historically was the case. So saying historically we had all this, evidence that, stocks or whatever, stocks don't always beat bonds. Now they beat bonds over, if you take a long enough time frame, you could say that they beat them over, this many, if you take this many years, but we also don't know that that's even a guarantee that that will continue to be the case. So what always, freaks me out about that is like, you have to plan for what historically didn't happen to happen. And that is like, to me, the basis of a sound framework for investing is you have to build a portfolio where, yes, you want U.S. stocks to rip 100, like for the rest of time, but you have to plan for the event that doesn't happen because you only have one shot at your investing time period. Does that make sense?
It does. It does make sense. And I mean, there are different ways that people have tried to express that. I've seen some pretty crazy portfolios that take what you're saying to the extreme, where it's like we're going to have 10% gold, 10% stocks, 10% Bitcoin, like every possible thing that's going to perform potentially differently from the other stuff. So I don't disagree with you. And bonds are a pretty tame example of diversification, obviously. And I'm not advocating for 100% stock portfolios. We have not very many clients at our firm that are actually invested that way. I think it's an interesting idea. But yeah, I mean, there are limits to that thinking. We don't know the distribution of all future asset returns. And because of that, we don't know which assets are going to be good diversifiers. I think looking at historical data is one interesting lens, but I agree with you. Like if you look at just the theory and forget about that empirical paper, yeah, of course bonds make sense. But then you look at the empirical paper and it's like, well.
yeah. Okay. This gets me to actually where I want to sort of try to start wrapping things up, which is through listening to the Boggles, to the Ben Felixes of the world, to all you smart guys who are reading all these papers, I've sort of come to an interesting place where the fundamentals are sort of undisputed in a lot of these circles, where it's like, okay, passive investing, you get what you don't pay for. Most active investors will lose, so the average makes sense. And then it's almost like when you get into like the basics of fitness and then you get into advanced fitness, where there's all these new papers that come out and people excitedly rush into these like new theories about like how to optimize the, the little tidbits of this or that. But they are sort of making tiny little, I would say theoretical, I don't know, bets is the right word. I guess in finance, it's a little bit more of bets because you don't know the outcome. But ultimately, when you do think about people who are not plugged in, what do you think about, this is, I guess, where we're going to end where we started, which is what should most investors, okay, that they're not reading journals, they don't want to pay attention to any of this stuff, they don't want to be worried about, sort of what the latest paper says about allocation. What is like the basics? And then we can't tell them what portfolio to build because obviously they need to make their own decision based on that. But let's get back to ignoring like the daily trends of, I know it's not daily, but like the year to year, decade to decade trends of, we think this is interesting. This is, a slightly better way to do it. What is the, not advice, but framework for most people to think about investing? Going back to For Idiots.
So let me give you an interesting example. We talked about factors. We talked about the Fama French 3-factor model. We didn't get to the 5-factor model, and that's okay. But there's this term that's been created in academic finance called the factor zoo. And that term was created because there were so many documented factors. There were so many, they're called pricing anomalies, like so many observations that this type of stock or that type of stock did better than other models would predict. And for the exact reason that you're saying, that is a problem for someone who's trying to optimize down to the most recent paper. So I don't think that anybody should be doing that. The problem that creates for people who want to pursue factor investing is that there's always competing models. So the Fama and French have a model, but there's a ton of other models out there. And a lot of people say now that, well, the Fama French model is no longer relevant because of this, this, and this. So if you're a Fama French value investor, it's really hard to stick with your value portfolio when it's underperforming and people are saying, well, no, Fama and French are wrong now because of this, this, and this. You should be using this factor model. So for most people who don't want to get into the details of why they think Fama and French are still right, they should probably not pursue that type of investing. Now, some people can do it. Like we have an online community for our podcast called the Rational Reminder Community, named after our podcast. And there's a bunch of people in there that like, it blows my mind, honestly. I love that community and I interact in there often, but there are people in there that literally nerd out all day, spend hours in there talking about, value should be defined this way. No, it should be this way. Or like momentum is a good factor or no, it's not. So some people love that. And I mean, I think that those people probably treat it like a hobby. That is not most people. The Rational Reminder community is not most people. So I think for someone who's listening, for the Investing for Idiots listener, the intended consumer of this podcast, they should probably be using low-cost index funds that just track the market. Now, whether that's US or globally diversified, I don't know, man. Like there's funds like VT, that's not a recommendation, but that's an all-stock global portfolio. That's a pretty nice security as a starting point, at least on the equity side of a portfolio. One thing, you don't have to think about it, you don't have to worry about it. In Canada, we have similar products called asset allocation ETFs. They're not quite like VT because they give an overweight to Canadian stocks. They're not market cap weight, but same idea. One thing, and you buy that and that's your portfolio. I think that level of simplicity, like we talked about investor behavior earlier too, when you look at the data on that, funds that are self-contained, that rebalance themselves, they tend to have much lower behavior gaps. Investors tend to behave much better in those products. So for the typical person that's listening to this podcast, that's like trying to learn about investing and they want to just make good decisions, total market index funds, market capitalization weights are a great starting point. And the more simple you can make it, the better you're going to be in the long run.
And if I could humbly add one tiny thing to your great wrap up there, low fees. We didn't really touch too much on because ETFs and mutual funds have their own set of fees involved. You need to pay attention to that and keep it as low as possible. Felix, you have been a fascinating character for me to learn from, and I really appreciate you coming on the show. Where can people find you? Obviously, you have the Rational Reminder podcast and you have the YouTube channel. Is that your main two outlets where people can discover your work?
Yeah, I release videos every 2 weeks on my YouTube channel. And then you just search Ben Felix, I guess, on YouTube and you'll find my channel. And then Rational Reminder, we post an episode every week. Those are they're pretty nerdy. I mean, if people want to be really get into the weeds, I guess, that they can listen. But I mean, yeah. Investing for Idiots is not Rational Reminder's intended audience.
Yeah, and that's not that's fine. These are our meme coin investors, our Wall Street bets guys. Okay, thank you for watching. We'll see you next time.